Hello everyone. Today in this video, let's have a discussion on an important chapter of company accounts, that is alteration of share capital and internal reconstruction. Before we understand the meaning of alteration of share capital and internal reconstruction, we need to know why a company has to alter its share capital and what are the reasons that forces a company to internally reconstruct itself. There are numerous reasons for the company to opt for internal reconstruction. Let's see some of them. The first reason could be the problem of overcapitalization. That is, the company might have issued the debts and equity more than the value of its assets. As a result, the company might be paying huge amount of interest on debt as well as dividend on equity when compared to its ability to pay them. The second reason could be the huge losses suffered by the company in the past few years. And the third reason could be the overvaluation of fixed assets, that is, the company might have not provided for sufficient amount of depreciation in the past. All these reasons may place a company in serious financial difficulties. In fact, it may force a company to take timely decision. So in such a case, the company will have two options, that is, either to liquidate the company, whereby the company has to completely close down its business, or if the company wants to come out of all these problems, then it can exercise its option of internally reconstructing itself. In most of the cases, when the company feels that there is every chance of making profits in the future, then obviously it will choose second option, that is internal reconstruction. Now, having said the reasons for internal reconstruction, let's see the exact meaning of alteration of share capital and internal reconstruction. Internal reconstruction is an arrangement under which a company, instead of going into liquidation, reconstruct itself internally by merely altering or reducing the capital of its shareholders and the claims of its debenture holders and creditors with their consent. Which means that internal reconstruction is an arrangement or agreement whereby company need not go into liquidation, but it has to reconstruct itself internally by either altering or reducing the capital of shareholders. When I say shareholders, it is both equity shareholders and preference shareholders, as well as the claims, nothing but the amount due to the debenture holders and creditors taking their permission. To put it in a simple words, under internal reconstruction, what the company does is that it prepares a reconstruction proposal and places it before the stakeholders, that is shareholders, debenture holders and the creditors, and it requests them either to alter or reduce their holdings and the claims in the company. Then the stakeholders may think that if the company continues with the same amount of capital and debts, then in the near future the company may be closed down, that is, it may go for liquidation. Instead of that, if we give our consent for alteration or reduction of capital and the debts of the company, then in the future the company may cover up its losses and may turn into be a profitable company. So keeping in mind the advantages of going into internal reconstruction, the stakeholders may give their consent. As a result, the company will go ahead with the scheme of internal reconstruction. Then, the essence of internal reconstruction is that there is neither liquidation of existing company nor the formation of new company, but there is only reconstruction of company internally, which means that under the internal reconstruction, there will not be liquidation of existing company, nor do they form any new company, but they will just alter or reduce the capital and debts of the company and continue the same existing company even in the future. Internal reconstruction can take the form of either alteration or reduction. Let me explain it with a very simple example. Let's say a company has 50 lakh amount of equity share capital divided into 50,000 equity shares of rupees 100 each. As I said, internal reconstruction can take place in two forms, that is either alteration of share capital or reduction of share capital. First, let me give an example for alteration of share capital. In the present example, you can see that face value of one equity share is rupees 100. The company may feel that rupees 100 face value for one share is too high. So let us subdivide the share from higher face value to the lower face value. In this case, they may reduce the face value from 100 rupees to 10 rupees. So now what will happen to the capital after internal reconstruction? Here one thing you have to remember that in case of alteration of share capital, the total capital remains the same. It will not change. So in the present example also, after internal reconstruction, the total capital is going to be the same 50 lakh rupees. Then the face value has now become 10 rupees. What will happen to the number of shares? What is the formula to calculate the number of share? Total capital divided by face value. So 50 lakh divided by 10, you get 5 lakh. So the new capital of the company after internal reconstruction is total 50 lakh divided into 5 lakh equity shares of rupees 10 each. Here one thing you can observe that in case of alteration of share capital, total capital has remained the same, that is 50 lakh. There is change with regard to the face value, that is from 100 rupees the shares have been subdivided into face value of rupees 10, and obviously the number of share also has increased from 50,000 to 5 lakh. So this is how the alteration of share capital take place. Then let's see the reduction of capital with the same example. Here also company has same amount of capital, that is 50 lakh capital, which is divided into 50,000 equity shares of rupees 100 each. In case of reduction of capital, what the company does is that it requests the equity shareholders to reduce their capital. Let's say in this case the company has requested the shareholders to reduce their capital from 50 lakh to 30 lakh. So after the internal reconstruction, the new capital of the company is going to be 30 lakh. But in case of reduction of capital, the face value will remain the same. So here in this case, face value is going to be same 100 rupees. So now what will happen to the number of share? 30 lakh divided by 100. So number of share is going to be 30,000. So this is the capital after the internal reconstruction, that is total of 30 lakh capital divided into 30,000 shares of rupees 100 each. So this is how the reduction of capital happens. Now you might have observed one thing. In case of alteration of share capital, the total capital remains the same. There will be change only with regard to the face value and the number of shares. But in case of reduction of capital, the total capital itself reduces. In this case, from 50 lakh, the capital has been reduced to 30 lakh. That means almost 20 lakh amount of capital has been reduced. Now you may get a question like why the shareholders will agree for foregoing this 20 lakh rupees. Is it not a loss for them? Answer is yes. Let me tell you why. Shareholders feel that if the company continues with the same amount of capital, then in the near future it may be liquidated. And you might have seen that in case of liquidation, there is order of payment in which the liquidator has to distribute the total receipts of the company, and the equity shareholders appear as a last item in the order of payment, which means that if the receipts of the company are not sufficient to pay all the debts of the company, then the shareholders will not get back even 1 rupee. So they will feel that if we compromise for foregoing this 20 lakh rupees, then at least in the future the company may turn into a profitable one and we may get good amount of dividend in the future. That's why they will agree for the scheme of reduction of capital, that is foregoing this 20 lakh amount of capital in the present example. So now this is regarding the meaning of alteration of share capital and reduction of share capital. Now let's move to the next concept in the chapter, that is differences between external reconstruction and internal reconstruction. In order to differentiate between external reconstruction and internal reconstruction, we need to know the meaning of both the terms. Just now we discussed the meaning of internal reconstruction. So now let's see what is the meaning of external reconstruction. External reconstruction is a case where the existing company will be liquidated and they themselves will form a new company with the same members or most of the members of the existing company in order to take over the business of existing company. Unlike the internal reconstruction, in case of external reconstruction, there will be liquidation of existing company and also formation of new company by themselves for the purpose of taking over the business of existing company. So that is the meaning of external reconstruction. Now let's see the differences between external reconstruction and internal reconstruction one by one. So first point says that in case of external reconstruction, one company is liquidated, that is the existing company is going to be liquidated. But in case of internal reconstruction, no company is going to be liquidated. The second point says that in case of external reconstruction, a new company is formed, that is, as we discussed in the meaning, the existing company is going to be liquidated and they themselves will form a new company. So in case of external reconstruction, there is a formation of new company. But in case of internal reconstruction, there is no formation of any new company. They will just do the internal arrangement within the company. That is, they will do the alteration or reduction of capital as well as the debts of the company. They are neither going to liquidate the company nor they are going to form the new company. Then the third point says that in case of external reconstruction, there is no need for the court's permission. Means they need not obtain the permission of the court in order to carry the external reconstruction. But in case of internal reconstruction, obtaining the court permission is very much required. Then the next point says that the external reconstruction is an easy and speedy process. But in case of internal reconstruction, it is very slow and tedious process because internal reconstruction requires court's permission. The last point says that the creditors and debentures holders may or may not continue in the new company in case of external reconstruction. But in case of internal reconstruction, the creditors and the debenture holders will continue. It is because in case of the external reconstruction, the existing company is going to be liquidated. If the creditors and debenture holders do not want to continue in the new company, then they can ask for settlement of their dues. In such a case, those creditors and debenture holders will not continue in the new company. But that is not going to happen in case of internal reconstruction because there is no liquidation of any company. So that is why whoever the creditors and debenture holders were there before the internal reconstruction, they themselves are going to be continued after the internal reconstruction also. So these are the differences between external reconstruction and internal reconstruction. Now let's move on to the next concept in the chapter, that is forms of internal reconstruction in detail. As we have already seen in the meaning of internal reconstruction, it mainly takes two forms. They are reorganization or alteration of capital and the second one, reduction of capital. Let's see one by one in detail. The first point, reorganization or alteration of capital. It refers to rearrangement of capital of a company, which means that the rearrangement of capital can be done with regard to the total capital or the face value or even the total number of shares. This reorganization or alteration of capital includes various types. Let's see one by one. The first point says that increasing the share capital of a company by making fresh issue of shares. At the time of internal reconstruction, if the company feels that they are in need of additional funds, then they can go for making fresh issue of shares. Whatever the additional funds they get, that can be used for paying the some debts of the company. Then the second point says that decreasing the share capital by cancelling the unissued shares. What is the meaning of unissued shares? I'll explain with an example. Normally, a company's share capital is divided as authorized capital, issued capital, subscribed capital, called up capital and paid up capital. What is the meaning of authorized capital? Authorized capital is the maximum capital a company can raise from public. For example, in this case, authorized capital of a company is 1 crore rupees. Then the second point, that is issued capital, it is the part of the authorized capital, which means that is the actual value of share issued to the public for subscription. Let's say company so far has issued 90 lakh value of shares to the public for subscription. Then what is the subscribed capital? Subscribed capital is a part of issued capital, which means that what is the actual number of shares and what is the actual capital public have subscribed for. In this case, let's say there is full subscription, so it is same 90 lakh rupees. Then we have called up capital. Company, what called up capital means, what is the capital the company has called out of the subscribed capital. Let's say 85 lakh. The company so far has called for 85 lakh from the shareholders, and paid up capital is a part of called up capital. What is the capital the shareholders have actually paid to the company? Let's say they have paid full amount, that is 85 lakh. Now the second point here under alteration of capital says that decreasing the share capital by cancelling unissued shares. So now what is the meaning of unissued share? That is the difference between authorized capital and issued capital. Actually the company can raise maximum amount of 1 crore from the public, but so far company has issued only 90 lakh. So remaining 10 lakh rupees becomes the unissued capital or unissued shares. Under the internal reconstruction, they say that they want to cancel the unissued share, means this 10 lakh rupees will be cancelled, whereby the authorized capital is going to be brought down to the issued capital amount, that is 90 lakh. So anymore authorized capital and issued capital is going to be one and the same, that is 90 lakh. That is how they are going to decrease the capital by cancelling the unissued share. The next point says the conversion of fully paid shares into stock, which means that under the internal reconstruction, if the company has fully paid shares, it can be converted into stocks. Stocks are nothing but it's a bundle of shares. One bundle can have 100 shares, 200 shares, 500, 1000, any number. So that can also happen under alteration of share capital. Then the next point, reconversion of stocks into shares, which means that before the internal reconstruction, if the company has already converted fully paid shares into stocks, then under the internal reconstruction, those stocks can be reconverted into fully paid shares. Then the next point, we have consolidation of shares of smaller amount into shares of larger amount. Let me give an example. If the company has 10,000 shares of rupees 10 each, the total capital comes to 1 lakh rupees. So here whatever 10 rupees face value you have, the company consider it as smaller amount, and now they want to consolidate the shares and make it as larger face value. They can make it as 100 rupees. Then under the consolidation, the total capital remains the same, that is 1 lakh rupees. What will happen to the number of shares? 1 lakh divided by 100, it comes to 1000, which means that before the consolidation, the capital of the company was 10,000 shares of rupees 10 each, that is 1 lakh. But after the consolidation, the smaller value has become larger value. As a result, total capital of 1 lakh divided by 100, the number of share has come to 1000. That is how the consolidation take place. Then the next point here you have subdivision of shares of larger amount into shares of smaller amount. It is quite reverse to the example I gave. Before the internal reconstruction, company will have larger amount of shares, that is might be 100 rupees. In such a case, before internal reconstruction, the capital would be 1000 shares of rupees 100 each, which comes to 1 lakh. But now they are going to subdivide the shares, that is from 100 rupees they are going to make as smaller value of share. In such a case, after the subdivision, the capital of the company will be 10,000 shares of rupees 10 each, that is 1 lakh. So these are the types of alteration of share capital. Now let's go to the reduction of capital. Reduction of capital is an arrangement under which claims of debenture holders and creditors are reduced, and the amount so reduced is used for writing off accumulated losses, fictitious assets and the overvalued portion of fixed assets, which means that the claims of debenture holders and the creditors are reduced, which means they are foregoing their claims. Then that amount will be transferred to a separate account. Such amount can be used for writing off the accumulated losses. Accumulated losses means profit and loss account debit balance, which you see under the miscellaneous expenditure of asset side of the balance sheet. Then fictitious assets. Example for fictitious assets are preliminary expenses, discount on issue of shares, discount on issue of debentures, etc. Then writing of the overvalued portion of fixed assets. For example, the actual value of machinery might be only 2 lakh rupees, but in the books of accounts it is stated at 2,25,000. So when you take the difference, remaining 25,000 becomes the overvalued portion of the fixed asset. So now the amount forgone by the debenture holders and the creditors, it can be used also for writing off the overvalued portion of the fixed asset. In addition to that, such amount can also be used for returning the excess capital to its members at its discretion, which means that such an amount can also be used for returning the excess capital if the company feels that whatever the capital they have, it is far in excess of the requirements of the company, then such amount can be used for returning to its members. Members are nothing but shareholders at the discretion, means at the decision of the company. Reduction of capital includes the various types. They are extinguishing or reducing the liability of the members for the uncalled capital, then reducing the capital by returning the excess capital, and the last one, writing off the capital which is lost. Let's see one by one. The first one is extinguishing or reducing the liability of the members for the uncalled capital. Let me give an example. If the company has 5,000 equity shares of rupees 100 each, out of that rupees 50 each paid up, which means that the face value of one share is rupees 100, but so far the company has called up 50 rupees and the shareholders have also paid 50 rupees. Under the reduction of capital, the company wants to extinguish or reduce the liability of the members for the uncalled capital, whereby they want to make it as fully paid up. So they will make it as 5,000 equity shares of rupees 50 each fully paid up. So thereby the remaining amount, that is the difference between 100 rupees and the paid up value of 50 rupees, so that is the uncalled capital that they are going to completely cancel and they are going to make it as fully paid up share. Second point says that reducing the capital by returning the excess capital to the members, that is the shareholders. Let me give an example. If the company has 5,000 equity shares of rupees 100 each fully paid, so here the face value is 100 rupees and the entire 100 rupees has been collected by the company. But now the company under the internal reconstruction feels that the 100 rupees whatever they have collected, that is far in excess of the requirements of the company. So out of that, maybe they want to maintain 75 rupees. So remaining 25 rupees, they feel that it is the excess amount. So now under the internal reconstruction, on 5,000 equity share at the rate of rupees 25, they are going to return to the shareholders. Thereby they are going to reduce the capital to 5,000 equity shares of rupees 75 each. The next point is writing off the capital which is lost. Here you are going to make a comparison between paid up value of the share with the worth of the asset per share. For example, here you have 5,000 equity shares of rupees 100 each fully paid, which means that the face value of one share is rupees 100 and the company has collected 100 rupees from the shareholders. But at present, at the time of internal reconstruction, worth of asset per share is only 75 rupees. Though the paid up value is 100 rupees, it is represented by only 75 rupees. That means the remaining 25 rupees is unrepresented by asset. So under the internal reconstruction, they want to write off that capital which is lost, means which is unrepresented by asset. So here the difference between 100 and the worth of asset is only 75. So remaining 25 is unrepresented part of the capital that they want to cancel. So that is how the writing of the capital which is lost will happen under reduction of capital. So these are the various types of reduction of capital. Now let's see the legal provisions for the internal reconstruction. Now let's see the legal provisions of alteration of share capital. Section 61 of the Companies Act of 2013 deals with the power of limited company to alter its share capital. According to this section, a limited company having a share capital, if authorized by its articles, means articles of association, can alter its share capital by passing ordinary resolution in general meeting. It does not require any special resolution. Just an ordinary resolution will be enough for altering the share capital. Such alteration does not require the confirmation by NCLT. NCLT stands for National Company Law Tribunal, which means court. However, the notice of such alteration shall be given to the registrar within 30 days of such alteration in e-form SH7 with certified copy of ordinary resolution along with explanatory statement and altered copy of memorandum of association. So these are the legal provisions of alteration of share capital. Then let's see the legal provisions of reduction of capital. A company limited by shares or limited by guarantee having a share capital may reduce the share capital by passing a special resolution. So here you can just compare. In case of alteration of share capital, you require just an ordinary resolution in the general meeting, but here for reduction of capital, you require special resolution. And here it is subject to the confirmation by the tribunal, that is National Company Law Tribunal, which means the court. So here also you can just make a comparison. In case of alteration of share capital, it does not require the confirmation of the court, but in case of reduction of capital, it requires the confirmation of court. So these are the theory aspects of internal reconstruction. Let's discuss the journal entries and problems in the next session. Thank you for watching the video.